I think the reason why groups like ours have a substantial exposure to residential, and to put that in context, if you look through all of our funds across the board, we're more than 70% invested in the residential sector at the moment, is that I don't think it's often in your investing career that you see a market dynamic where you have very low vacancy, exceedingly high demand, supply side delays in terms of getting new product into the market. So that dynamic is not going to change quickly. High levels of immigration. And so for us, that really gives rise to an investable asset class that we have very significant comfort around. So we continue to really heavily focus on that as one of the major asset classes. I think we're at the start of the next cycle. So, we've been through a period where we've had construction costs substantially increase. Estimates are around 20 to, we've seen some projects where construction costs are up 30% on where they were pre-COVID. And so we've had this real lift in construction costs with a delay in off the plan realisation values really being able to keep pace with the lift in those construction costs. Something had to give in that equation. And the truth of that is that what's ultimately happened is realisation values. I don't want to overstate it, but we are starting to really see that uplift coming through, and a lot of projects that were previously not feasible are now feasible. And so I do think we're at the next cycle, the start of the next cycle, and we feel that's how it's going to play out over the next couple of years. We're seeing ongoing competition for those that want to develop. We are seeing competition for those that want to rent as well. As a proportion of total population, more people choosing to rent, because if you look at the cost of mortgage rates and basically home loans, and you compare that to the cost of rent, it's clearly saying that rent is becoming a much more affordable way to secure residential accommodation. So we do think that the proportion of renters are actually increasing. We have got a build-to-rent jointly owned platform known as GQ, and we are seeing very substantial capital demand into that particular sector, because long-term investors see the ability of owning substantial volume of residential apartments, enjoying long-term escalation of rents. So I think that will be an ongoing trend where institutions will start to own many buildings in Australia, as opposed to necessarily mum and dad type investors owning off the plan strata apartments. They're the key trends that we see at the moment. I think it's going to take really quite a long time. I feel that it takes time to put new supply into the market, and underlying supply is probably running at 20 or 30% of the actual amount that is demanded by the market, and it's just going to take time. So I don't think any of us have that absolute perfect crystal ball. I'm reticent to put a number out there, but intuitively I would feel this market is set for at least the next 3 to 5 years into this next stage, really because of the lag time of actually getting supply into the market. So that's my intuitive feeling. Really deeply think about the cash flows of the underlying property that you're buying. Yes, location is really important. Yes, the price you pay on acquisition is really important, but we are in for longer and higher interest rate environment, and not all properties behave exactly the same, and therefore really thinking about what is the long-term growth prospect of the cash flow of the property that I'm buying is really going to be now the secret to long-term success. I feel the days of you buy a property and you raise bank debt or any debt, and there's a margin between the yield of the property and the debt, and I can just make money by long-term ownership. I think those days are behind us, and mainly because the cost of debt is now significantly higher than what it was just 18 months ago. So you as the owner of a property really need to think about what your underlying growth prospects are for that property with the debt that you've taken on in order to finance the acquisition of that property. And that would be my most considered words for the question you've asked.